Welcome in our headliner now, Mark Yusko. He's the CEO and CIO of Morgan Creek Capital. Welcome. Good to see you. It's been a while.
Thanks, Scott. Thanks for having me on, and happy Friday.
Yeah, same to you. I hope you heard part of our conversation, at the very least, leading into you and these comments that Jeremy Siegel of the Wharton School made to us on our program yesterday, that he thinks we're in the third inning of this boom. Nothing to worry about until the Fed makes its first move. What do you think? You agree?
I probably wouldn't agree per se. I do think that, look, liquidity talks and liquidity drives markets. And so long as they keep getting these big stimulus bills passed, there is potential for the nominal value of stocks to go up. I think that's a dangerous game to play, though. I saw a great chart the other day, Scott. If you take the value of the S&P divided by the Fed balance sheet, it's been dead flat since 2008. If you divide the S&P by gold, it's been dead flat since 1996. So the nominal value keeps increasing, but we are losing purchasing power through the devaluation of our currency.
So let me ask you, what's there to be mostly negative about? Is it, do you have a problem with valuation? Because, multiples have come in, our earnings expectations continue to go up, rates are still incredibly low by historical standards. And Jay Powell has said repeatedly, including on our network yesterday in his conversation with Sarah Eisen, that they're not doing anything anytime soon, that any of the fears of inflation, at least in their mind, are overblown in the near term because they're transitory and temporary and they're going to go away.
Yeah, look, I mean, there's so many things to worry about in the sense of, valuations are silly or stupid. I mean, either one works. So whichever one you favor, go for it. Look, we've never been at these levels of overvaluation. We're 179% of fair value. So, that doesn't mean we can't get to 180 or 181 or 183% of fair value, but we've just never seen this level. And part of it is this idea of the Fed model, that as long as interest rates are low, then valuations can be high. Well, that's kind of a silly idea when you think about it. If we take it to its illogical extreme, if interest rates were zero, are stocks worth infinity, right? It breaks down under 2%. There's a lot of data on that. The last piece of it is economic growth, right? Economic growth was surprisingly weak in the fourth quarter. There's everybody who's hoping that it'll be better this year, but hope is not an investment strategy. And if we look at the gap,
it's going to be, though. Come on, you got to admit. I mean, you're not casting doubt on the rebound in the economy, are you? I mean, because by every single measure, there's so much pent up demand, Mark, that, you could have massive GDP numbers and this roaring 20s idea. Are you
totally
casting doubt on that?
Totally disagree. It's just the base effect, right? You're growing off a small number and people just don't want to do the math, right? If you go down 30%, you don't have to be up 30% to get even. You got to be up, closer to 50%. So that's the problem is, yes, the headline numbers will be big, but we're still going to be materially below where we were. And remember, we were averaging sub 2% GDP growth over the last decade. We're going to go right back to that level within the next 12 months. And that's nothing to really get excited about because we'll be below trend by a pretty significant margin.